In the world of investing, the saying goes, higher risk, higher returns. Of course, this means the opposite is also true. Lower risk investments are likely to generate lower returns. How do we at Temasek compare investments with varying returns and risk and decide what investments to make? Let's look at two investments, Company A and B. We start by assessing both companies' fundamentals. This helps us to evaluate their future prospects and project their expected returns. Here, an investment in Company A could potentially yield 10% return, while Company B may deliver 18%. At face value, an investment in Company B looks better because of its higher expected return. But that's not all. We have to consider risks too. As an investment discipline, we use what we call the risk-adjusted cost of capital to account for the different risks faced by each investment. This considers country, sector, and company-specific risks and enables us to make like-for-like comparisons between Company A and B. What if the risk-adjusted cost of capital for Company A is 7% and that for Company B is 16%? This means the potential returns for Company A is 3% higher than its risk-adjusted cost of capital and only 2% for Company B. This gap is called the spread, and our goal is to maximize the spread. Now that we've taken risk into account, Company A is the more attractive investment compared to Company B. This means that when we deploy our capital, we prioritize investing in Company A before Company B. In today's low-return environment, more investments are returning below their risk-adjusted costs of capital. However, this doesn't stop us from looking at investment opportunities. What happens if we only have Company X and Y as potential investment opportunities and both have positive expected returns but negative spreads? Let's say Company X has a negative spread of 1% and Company Y has a negative spread of 8%. Here, we will still prioritize Company X over Company Y as Company X has a lower negative spread than Y while still giving us positive returns. In this environment, we continue to deploy capital actively with a long-term mindset while also keeping enough cash for a rainy day. This is by no means a mechanical process as we're dealing with financial estimates and projections which are not absolute. We remain mindful of other risk factors such as global event risks as well as the longer-term or disruptive trends. At Temasek, we invest mostly in equities, which are inherently more volatile. The risk-adjusted cost of capital is one important yardstick to remind us of the underlying risks we take in our investments, and it helps us balance risks and returns more prudently. This discipline enables us to better deliver sustainable value for our portfolio for generations to come.